Welcome to Vinoc Resources, and we are presenting to you Introduction to Finance and Business. We are going to look at the forms of business entities, sources of capital, and also some special terms in finance. Let us look at some forms of business entities. We have three main types of business entities. First, we have the sole proprietorship, we have partnerships, and lastly, we have corporations. Those are the three main forms of business entities. Let us look at the definitions of the three forms of business entities we have seen earlier. We have sole proprietorship. These are private businesses that are usually owned by a single person or an individual or an entity. For partnerships, these are business formations that are owned by two or more people who have come together to make a joint venture of a business. These partnerships, they don't sell the stocks in the stock market, so they're not public, they're private, and they can be classified into three major partnerships where we have general partnership or limited partnership or limited liability partnership. So the third corporations, these are public businesses which operate separately, entirely separately from the owners or the shareholders. These businesses sell their stock or their shares in the stock market and they have limited liability. Let us dive deeper into some of the facts about each of the forms, starting from proprietorships. The advantages are there is to start, is to operate, no private sharing with anybody, ownership is full control by the owner, is taxed as a personal income. The disadvantages are once a person dies, who is the owner, the business goes out of business. We have unlimited liability, and also if there's any losses, it is only shared by one person, and it's not easy to transfer ownership of this kind of business from one person to another. Let us look at some of the facts about partnerships. The advantages are it is taxable as a personal income. The partners are only liable for any amount of money they invest in the business. It is simple and easier to start compared to corporations. The owners have more access for capital than sole proprietors. Let's look at some of the disadvantages of partnerships. They're not easy to transfer ownership from one partner to another. They dissolve once one of them dies or one of them just wants to dissolve or not to be part of a partnership. Let us look at the most complex form of business called corporation. Its advantages is that it's easier to transfer ownership from one person to another or from one shareholder to another. It has limited liability, its access to fast capital, and it can go on forever without collapsing, or even if a person dies, it's going to go on. Disadvantages is double taxation, where you pay taxes at corporate level and when the dividends are distributed. Then we have more regulations and laws for corporations when you compare them with partnerships and sole proprietorships. These business entities have got different sources of capital. The three main ones are equity financing, debt financing, and also the internally generated funds. Of all these three, The main source of capital for corporations is equity financing, followed by debt financing. Let us look at equity financing. This is the main source of capital for big corporations. It's simply selling part of ownership to raise capital. Big corporations or big entities that we call big public companies, they sell shares in the stock market to raise capital for their operations. And those shares that are sold is actually giving up some part of ownership to the investors such that you can have money to finance the business operations. Debt financing. It means simply to borrow money and pay that money back with an interest. That's contrary from the equity financing where you have to give some ownership to get some money for capital. This one with debt financing, you don't have to share ownership with the lender, but you have to pay the lender back the money with interest. So it has some advantages because you don't sell your ownership to the lender, but you gain or retain your ownership. Some of the examples of financing or debt financing are the bank loans and bonds. Some of the words that you can come across is stocks and stock market. Let's look at some of the distinctions between those two words. A stock is a piece of ownership in a company. Sometimes it's called a share. Shareholders who buy shares or a stock have ownership in that particular company. So if you have a share, you are called a shareholder. And a share is simply part of ownership or a piece of ownership of a company. Investing in stocks is the most widely method that is used in investing in public companies. What is the stock market? It's any virtual or a physical place where stocks are exchanged from one person or from one investor to another. Example stock markets include the New York Stock Exchange, Nasdaq, TSE, SSEs, Euronext, etc. Let's look at the common terms which you can see in this finance and business world. We have a share or a stock is part of ownership or in a public company. Public company is an entity or organization that sells its shares in the stock market or stock exchange market. A shareholder is an investor who has a share in an public company. A share price is the price or value of one share in a public company. Dividends is the regular distribution of profits to the shareholders. Just the company tries to distribute some of its profit to the shareholders is what we call dividends. Then we have the ticker symbol. It's a unique and a short name that is used in the stock exchange market to represent a given company. The initial public offering, sometimes called IPOs, is the first time when a company goes public by selling its shares in the first time to investors. Primary and secondary markets. The primary market is a market where public companies sell their shares directly to the public for the first time as an IPO or initial public offerings or during the private placement. Secondary markets is a market where the investors, those are the shareholders, they buy and they sell shares of an existing public company. We have come to the end. I hope you have enjoyed the video. Please comment your questions and subscribe at Vinac Resources. And thank you.